Where do interest rates go from here? We recently saw the Fed come out and raise the Fed funds rate by 0.75%, taking us up to 2.5%. That's the highest level we've seen since 2018. At the same time, we're seeing mortgage applications decline, which is showing up in mortgage demand being at its lowest level in nearly 2 decades. And part of the reason we're seeing this slowdown is because of interest rates rising and it being 80% more expensive to buy a house today than it was in June 2019. That's 3 years ago. It's gone up 80% with regards to purchase prices, and because of interest rates going up, it's affecting affordability out there. And for those of you not familiar with what's happened over the last couple of years, the Fed is essentially the one that created this mess, taking the Fed funds rate to near zero during the pandemic, at the same time purchasing $120 billion per month in mortgage-backed securities and treasuries, and also taking interest rates down. Those things helped drive interest rates down on top of pumping a bunch of money into the economy. So house prices shot up. And so what we've seen recently is because of the rise in rates, we've seen inventory build, we've seen housing demand for houses actually decline, and now we're starting to see price drops, we're starting to see some stabilization with regards to the market, less of the craziness that we've had out there. And again, that's why the Fed came out and raised the Fed funds rate by 0.75%, because we've had the hottest inflation that we've seen in nearly 4 decades. So what does all of this mean for interest rates? That's what I want to talk about now. A lot of people believe because the Fed raised the Fed funds rate 0.75%, that means interest rates are actually going up 0.75%. But keep in mind, the Fed doesn't control interest rates. The Fed controls the overnight lending rate in which banks borrow money from each other. This rate is essentially a short-term interest rate for loans less than 1 year, while most mortgages out there are at least 15 years, in many cases 30-year fixed mortgages. So the Fed funds rate doesn't directly impact interest rates, but it does have a play on some of the shorter-term loans out there. So let's take a minute here and talk about what the market's doing at the moment and give you some ideas of what to expect over the next couple of months. So lately, we've actually seen interest rates stabilize. Today, we have 30-year fixed rates just under 5%, which takes us back to early May, around May 5th, as you can see from this chart right here. Back then we saw rates peak just about where they are today, and then we actually saw them decline a little bit, and then we saw them go upwards of over 6%, and then back down to the range that we're trading in today. So every single day interest rates move, but the good thing is we're not seeing huge spikes. We're not seeing a lot of volatility in the market, and that's what's causing this stabilization in rates. Now, you might call a mortgage broker today and have a conversation, and the interest rate might be 5.25, and then tomorrow you might call and it might be 5, and 3/8. So they do change daily, but what we're talking about here is big changes in the rates. There's a lot of people out there that believe interest rates are going to 7, 8, 9%. And I just don't see it. I see more stabilization in what's actually happening with regards to rates. Now, as I mentioned earlier, people believe that because the Fed raised the Fed funds rate 0.75%, we were going to see interest rates increase. Well, we actually saw the opposite. Interest rates kind of stayed the same, pulled back just a little bit. Why? Because the market was expecting the Fed to do exactly what they said they were going to do. And they came out and they delivered. And therefore, the market liked it. It was almost a sigh of relief that the Fed did what the market was expecting, and therefore rates pulled back because it was already built in. And because the Fed is pretty transparent these days, they come out and try to give the market some expectations of where they see the Fed funds rate in coming months, what they expect to do with regards to increases. And the reason they do that is so that the markets can actually bake it into the cake, if you will, so that the market doesn't overreact to what they decide to do on meeting day, right? They're trying to give the market what they want by telling them up front exactly how they plan to move forward. And so the market did that, therefore rates stabilized, and they've actually pulled back. We've actually been in this trading range for a couple of months now. We've seen rates creep up, we've seen them creep down, but for the most part, they've been trading somewhere around that 5.5% level. In fact, I did a video a couple weeks ago where I asked if this was the peak in mortgage rates. And if you want to see that video, check it out here. But what I see happening in the future over the next couple of months is more stabilization. Now, the only potential hiccup I see in the stabilization is the fact that the Fed doesn't meet next month. They don't meet in August. Actually, the Fed only meets 8 times per year. And so next month is one of those months where the Fed doesn't meet. And we're going to get CPI numbers just like we've done over the last 2 months. Now, if the CPI numbers, the inflation readings come out and they're what the market was expecting, then you're likely to continue to see interest rates move sideways, potentially even pull back a little bit. But if you see a huge spike in inflation, well, guess what? The Fed doesn't meet. And back in June, when we had that unexpected spike in inflation, the Fed met the week after. So they were able to come out and do that 0.75% hike back then, which calmed the markets. Well, in August, we don't actually have the Fed meeting. So if a hot CPI number comes out and the Fed doesn't meet, you could see volatility in the market, which causes interest rates to move up. So if you're a buyer out there, you're someone looking at the market, just keep this in mind. If there's a saying going around, if you like it, lock it. Don't try to base your decisions on what you think the market's going to do unless you're a pro, unless you're an expert. In fact, even the experts out there have problems predicting the direction of interest rates because many times there's things that come out that are just unexpected that affects the markets and creates this volatility and in turn creates this change in rates, if you will. Now, what I will say is that many economists out there, investors, are actually expecting a recession within the next 12 months. At the same time, if you look at the Atlanta Fed GDP now, it actually shows that we have negative growth at the moment for the second quarter. Now, this actually won't be finalized until the end of September to confirm where these numbers end up. But if you read the definition of a recession, it's back-to-back quarters of negative growth. And so if we do have negative growth in this quarter, which again, we won't find out until the end of September, that means we're officially in a recession. And if we head into a recession, that means slower growth for the economy. In fact, we've already seen the economy slow. And with that being said, recessions are deflationary by nature, which means that inflation is likely to come down as the economy slows. Now, it likely doesn't drop back down to 2-3%, but it also probably doesn't stay at the highs. And as the economy slows, the Fed is going to look at that and they're going to have to make a decision whether they continue to pump the brakes on the economy by raising the Fed funds rate and letting the balance sheet roll off, or do they start to stimulate the economy again by buying mortgage-backed securities, by buying treasuries, by maybe actually lowering the Fed funds rate. There's a good group of people out there that believe sometime mid next year, you could actually see the Fed lower the Fed funds rate. So with all of this said, I think for the moment, interest rates probably stay somewhere in this mid 5% range. Could we see them go a little bit higher? Yes. Could we see them go a little bit lower? Absolutely. Are they going back to the lows? I do not think so. I don't see that happening anytime soon. But at the same time, I don't see them shooting up to 7, 8, 9% either. So if you're watching this wanting to know why I think we've seen a peak in interest rates, do me a favor, check out this video here. I dive into it in more detail. But for now, I appreciate you taking the time to watch. I appreciate your support. Hope to see you again soon. Have a great day. Bye-bye.